Nothing changes sentiment like price. 10 days ago, we were looking at a growth scare and a full-blown global meltdown. A little more than a week later, markets have more than retraced the losses, sitting just shy of another all-time high. Thursday's 1.6% market surge was rock solid. The price momentum never let up. In the last several weeks, even on strong up days, you would see lots of attempts to sell into the strength, take profits and or put on short positions. Not Thursday. All the attempts to do just that failed. At least for a day, investors were buying into the thesis that the Fed would stick the landing. I don't want to be a Debbie Downer, but the macro data isn't confirming the micro. Welcome to the Money Runner. I'm David Nelson. Thursday's market surge was driven by a retail sales number coming in at the high end of expectations, coupled with better than expected earnings from the world's largest retailer, Wal-Mart. The above begs the question, is good news at Wal-Mart coming at the expense of other retailers? Or are the reports from Home Depot, McDonald's, Brinker, Walgreens, and Amazon one-off scenarios and the economy is doing just fine? The truth rarely lives on the extreme, so I suspect it's somewhere in the middle. To be sure, a deep dive into the company reports mentioned above shows a challenged consumer, careful with discretionary dollars, and for some retailers and restaurants, margins were a struggle. Not so at Walmart, which shined in almost every category and managed to beat on margins. By the way, one of the data points in the retail report that should be at least mentioned was the big jump in auto sales, in part getting a bump in demand following a cyber attack that disrupted dealer operations in June. Markets and the economy are no different than the animal kingdom. The strong and the powerful thrive and the weak struggle to survive. While Walmart jumped to all-time highs, Dillard's cratered 10%, missing earnings by a country mile as margins collapsed. Enough of retail. Let's turn to tech. Secular investment themes, including artificial intelligence, like others in the past, will go through periods of peaks and valleys that will challenge both bulls and bears to defend their trades. Bulls will push their stocks beyond what current economics support, and bears will overstay their welcome. All new technology platforms go through these cycles, especially one as disruptive as AI. Not unlike the build-out of the internet in the 90s, the AI trade will continue to have these major corrections. But to date, I still see nothing to challenge the idea that this is one of the most important investment themes in a generation. I don't mean just stocks. I was a recording artist years ago, and I'm already listening to music created with AI prompts that will blow your mind. Check out my good friend Chris Patty's Sophia, a new digital artist. Let me know what you think.
Shadows fade in the glowing light, dancing through till the morning sight. Feel the night ignite in electric hue. Found my rhythm, I'm chasing you. Every heartbeat like a drum.
AI is a tool that even artists will embrace, but it will be the artist in partnership with technology. And again, you'll have to be an artist to make it work. AI will weave itself through the fabric of the industrial complex. It will be disruptive. It will stumble and fall, but in the end, will be indispensable as a technology platform everyone will embrace. Is NVIDIA ahead of its fundamentals? Maybe. But ask yourself where it will be in a couple of years. How about Broadcom, Dell, or Supermicro? Do you think the build-out of these data centers won't have the customers to justify the expense? Maybe in the short run, but I suspect long-term investors will be rewarded. The market is moving beyond the Mag 7. My original thesis was if the economy rolls over, the market will embrace the pristine balance sheets of Apple, Microsoft, Alphabet, Meta, and others. I think that's still true, but not all Mag 7 players are the same. Increasingly, I'm concerned with Alphabet and have since sold off about 25% of the position. The DOJ may be in the process of trying to break up the company, but that's not the big concern. First, the DOJ efforts, that could take a long time to play out, and there is always the appeals process. My real concern centers on search, the cash cow of Alphabet. Google will clearly be a leader in AI, but I'm already using other AI platforms for search like OpenAI, Perplexity, and others, and they're all good. By definition, Alphabet will lose some market share. Additionally, I'm not sure how the current business model will be able to monetize search in an AI world. What about the Fed? Maybe we give the Fed too much credit. Investors obsess over the Fed's next move. Will they or won't they cut? And if they do, by how much? And oh my God, what if they don't? I still believe the Fed is behind the curve. Real rates are still in restrictive territory. Inflation data continues to fall. Manufacturing data is still weak. And for my money, we're seeing cracks in the facade of the shop until you drop consumer. I believe the Fed needs to cut right now. It takes a long time for monetary policy to wash through the system. It was that way with rates on the way up, and it will be that way on the way down. When it comes to sticking the landing, the history of the FOMC, it's not good. But even if they're late, eventually they'll get it right. The bigger concern for me is what we saw last week. Markets don't crater without reason. The leverage unwind we saw last week could happen next time there's a liquidity crunch. Systematic traders running investment books levered up 3, 4, 5 times only need a trigger before it's déjà vu all over again. Like I said, it's always the smartest guys in the room that cause the most market damage. Well, that's it for this week. I hope you enjoyed today's pod. And if you did, you know the drill. Please hit subscribe. You'll find a lot more on my Substack site, dcnelson123 at substack.com. I'm David Nelson, and this is The Money Runner.